Good morning, FAC2602 students. Welcome back to another lesson as part of our exam preparation. As you all should know by now, the examination for FAC2602 will take place on the 24th of October 2022 at 8 a.m. So we just have another week in order to prepare or to finish our exam preparation. So as I've indicated yesterday, I will be finishing the January 2022 supplementary examination during this week or the remainder of it. And next week, we are going to focus on the FI concession paper, that being the paper that was written in September by those students who had less than one module to complete in order to graduate. So next week, we will focus on that paper, and then I will provide a set of suggested solutions for the 2021 exam papers. So that being the September 2021 examination, the June-July 2021 exam paper, as well as the January-February 2021 examination. All right, I believe that providing those suggested solutions, that you guys should be able to finish your exam preparation on a very high note, and that you can go and write the examination knowing that you have prepared as best you can. All right. Now, today's lesson will cover question 2 of the January 2022 supplementary examination. In the previous lesson, we have worked through question 1, which addressed the pro forma consolidation journal entries. So please make sure that you go through that lesson as well, if you haven't done so already. And just before we start, I would just like to say thank you for the positive feedback that you guys have been giving me. It really pleases me to know that I'm actually helping you in preparing for the module and that you actually understand the principles better, okay, after you have watched my lessons. So that is the whole purpose of these lessons, is to help you guys prepare as best as possible for the examination, and that you can say at the end of the day that you finished the module on a high note. Okay, we all want to obtain a pass at least, all right? Because that is the most important objective, is to pass the module as part of your degree or higher certificate or diploma. So yes, I hope to make a positive contribution through these lessons. Okay, now if we go to our required section, we are asked to prepare the following for the Ginger Limited Group for the year ended 31 May 2021. So the consolidated statement of profit or loss and other comprehensive income, the retained earnings and non-controlling interest columns in the consolidated statement of changes in equity, as well as the non-current assets section in the consolidated statement of financial position. So in the official examination sitting, you will just be required to do what the required section has stated. All right. However, for the purposes of ensuring thorough exam preparation, in this lesson, I will be covering I will be drafting the entire set of consolidated financial statements, meaning that we will do the consolidated statement of profit or loss and other comprehensive income, the consolidated statement of changes in equity in full, as well as the consolidated statement of financial position. Okay, I believe that this will be the best approach for you to take in preparing for the upcoming examination. You need to actually see if you understand all the principles that are applied in this question. However, in the examination on the 24th, you will just do what the required section has stated. Okay, because even though you do additional journal entries or do additional columns in, for example, the consolidated statement of changes in equity, and even though those entries that you've made or the columns that you've drafted are correct, you will not earn any marks for them, and you will lose that's what I meant to say. You will lose time. Okay, you cannot afford to waste time in the examination, especially with an accounting examination. Okay, we all know that an accounting examination is not time friendly at all, so we just have to focus on what the required section has required us to do. And for this question, they have given you a time limit of 67 minutes. So if you attempt this under exam conditions, you should be able to finish under an hour. Okay. However, we will not be spending just 67 minutes on this question because we will be covering the entire set of consolidated financial statements. So I believe we will just take about 2 hours. Okay, right. We'll see how far we get. I will try and cover question 2 in full in this lesson. However, if I am not able to do that, then I'll just continue in part 2. Okay, but we'll try our best to finish it in this lesson. Alright, but please note that this will be a long session. Okay, because of the volume of what is required of us. And I've changed the required section to prepare the group financial statements for the Ginger Limited Group for the year ended 31 May 2021. Okay, as usual, before we even start with reading the information, we need to make sure that we indicate our current financial year, because that will affect some of our journal entries and the particular account that will be affected. For example, if an intergroup sale took place in a previous period, we know that we will make use of retained earnings, right? So it's important for you to indicate your current financial year. So if the year has ended on the 31st of May 2021, it should have started on the 1st of June 2020. Okay, so that is the beginning of the financial year. And by stating your current financial year, you will also be able to determine if the group was formed in a previous period or if the group was formed in the current period. Okay, as we have covered in question 2 of the May-June 2022 examination, the group was formed in the current financial year, and then we had to calculate the pre- and post-acquisition profits. All right, in this question, that will not be the case. Okay, in this question, the group was formed in a previous period, and you'll see that when we get to the actual adjustments that we need to make. Okay, so after having read the required section, let's start with reading the information given. It says the following: Ginger Limited and Vitamin Limited are orange farms situated in South Africa. Now, since the COVID-19 pandemic, the demand for oranges increased globally. The financial year end of both entities is 31 May, and below is an extract from the trial balances of each entity on the 31st of May 2021. All right, and also from the required section, you should have been able to determine the parent. And since we are dealing with the Ginger Limited Group, we know that Ginger Limited will be our parent and Vitamin Limited will be our subsidiary. Okay, that is also very important that you distinguish between those two. Another way that you can determine this is by looking at your figures that are given, or look at the trial balances that are given. The subsidiary will always be listed last, so on the right hand side. Okay, so the parent will be listed first and then the subsidiary. Okay, that is another way that you can determine what company is the parent and what company is the subsidiary, or which company is the subsidiary. Okay, now before you start with additional information, okay, remember that your analysis of owner's equity is a very important calculation, especially when you are required to draft the consolidated statement of changes in equity as well as the consolidated statement of financial position. Okay, so it is important for us to determine the percentage interest of the parent in the subsidiary correctly. And before we get to additional information, we need to look if there is sufficient information in the trial balances in order for us to determine the percentage interest that the parent has in the subsidiary. And that will normally be found in the parent's investment in the subsidiary line. Okay, meaning if you go to your debit section, you will see that we have an investment in Vitamin Limited at fair value. All right, and we will use this information in order to calculate the percentage interest of the parent in the subsidiary's ordinary sorry about that, in the subsidiary's ordinary shares as well as preference shares. Okay, now if we look at the information, it says that Ginger Limited owns 120,000 ordinary shares issued by Vitamin Limited. So if we want to calculate the percentage interest, we will take the number of shares owned by the parent, which is 120,000 ordinary shares, and we will divide that by the number of ordinary shares issued by the subsidiary, which is 200,000 shares. All right, so you will divide 120 by 200, Okay, and that will give you a 60% interest. Okay, remember that Excel automatically calculates this as a percentage. So if the parent, which is Ginger Limited, owns 60% of the ordinary shares issued by Vitamin Limited, then your NCI would be 40%. Okay, this pertains to ordinary share capital, but we also have to draw up an analysis of owner's equity for preference share capital, because the parent also owns some of the preference shares that have been issued by the subsidiary. The same process is used to determine the percentage interest. We will take the number of preference shares owned, which is 56,000. Okay, so 56,000, and we will divide that by the number of preference shares issued by the subsidiary, which is 80,000. As we can see in the trial balance, only the subsidiary has issued preference shares. Okay, so the parent owns 56,000 out of the 80,000 preference shares, giving them a 70% interest. Okay, the same process is used to determine non-controlling interest, which is 30%. Because if the parent owns 70%, your NCI would take up the remaining 30%. And it's very important that you calculate these percentages correctly, because that will affect the allocation of, for example, ordinary share capital between the parent and the subsidiary, non-controlling interest rather, and it will also affect the amount for goodwill. Okay, so it's very important for you to calculate this correctly. Okay, do not make a simple mistake with this one. Okay, this is a straightforward calculation, and just something I need you to take note of. In the investment line, it says that the cost price of the ordinary shares owned was 3.6 million. Okay, so that was the original cost of those ordinary shares. It is now 4.1. Okay, so the value listed in the trial balance of the parent is 4,100,000. Okay, now you will notice, or you will see in Learning Unit 2, that they state that in FAC2602, you may assume that the cost price of the parent's investment in a subsidiary, so that being the investment in Vitamin Limited, is equal to its fair value. All right, but we can clearly see in this case there is a difference between the cost and the fair value of the investment. Okay, so for the purposes of this module, we will take the cost price and the fair value as being the same. Okay, so meaning that there is no change in the fair value of the parent's investment in Vitamin Limited. So what I'm trying to say here is that you only focus on this figure right here. All right, so 4.1. So if you enter the consideration received by the parent or from the parent, so in this line right here, consideration and NCI, you will enter the value of 4.1 million and not the 3.6, because 4.1 is the fair value of that investment as listed in the trial balance. Okay, normally these two would be the same in this model. I don't know why they differ in this one. Okay, but for this model, these two would be the same. All right, so you only focus on this figure right here. The same for preference shares. So let's enter those two amounts in our calculation. That being the analysis of owner's equity, both for ordinary shares and preference shares. So the total consideration received by the parent for ordinary shares was 4.1 million. Okay, once again, this will affect the calculation of goodwill, and the investment in preference shares amounted to 275. And the type of preference shares that we have would be 9% cumulative preference shares. So the dividend rate of your preference dividends would be 9. And the dividends will be calculated based on the value of the preference share capital, not the number of preference shares issued, as is the case with ordinary shares. With ordinary shares, you will calculate the dividend per share, whereas with preference dividends, you will calculate that dividend based on the value of the preference share capital in issue. Okay, that's very important. All right, so we have determined the percentage interest of the parent in the subsidiary's ordinary share capital as well as the preference share capital. And we also know that this will be eliminated at acquisition. Okay, this will be part of the elimination of owner's equity at acquisition. Okay, and this calculation right here should not take you very long. Okay, you just determine the percentage interest of the parent in both preference share capital and ordinary share capital. Okay, make sure that you have calculated this correctly, because it will affect the rest of your calculations that are all adjustments that are shown in the analysis of owner's equity. All right, now that we have done that, we can move on to additional information. So, as is the case with any other question, we will start with each point under additional information and work that point through from beginning to end. Okay, and make the adjustment at every possible place necessary that will have an effect, or every possible place that it will have an effect. Okay, right. So let's look at additional information point 1. Let me just have a sip of water before we start. Okay, so let's start with additional information point 1. It says the following. Ginger Limited acquired its controlling interest in Vitamin Limited to enhance the benefit of exporting fruits that are rich in vitamin C on the 31st of December 2018. Okay, so this will be the date of acquisition. Okay, the 31st of December 2018. And as I have confirmed at the beginning, the date of acquisition is in a previous period. Okay, more specifically 2 years ago. Okay, or 2 years before the current financial year. So therefore, the group was not formed in the current financial year, and therefore we do not have to calculate a pre and post acquisition profit. Okay, as we did in question 2 of the May-June 2022 examination. So in this question, the group was not formed in the current financial year, and therefore we do not have to calculate a pre and post acquisition profit for the subsidiary. Okay, because as we know, only the post acquisition profit can form part of the group's profits. Okay, and the pre-acquisition profit will be used to calculate the retained earnings balance at acquisition. However, that is not the case in this question. Okay, so the date of acquisition is the 31st of December 2018, and you will also indicate that in the analysis of owner's equity for preference shares. Okay, this doesn't really count marks, specifically relating to the dates. Okay, the dates themselves do not count marks. Okay, it's just for you to make sure that you make the adjustments in the appropriate section. Okay, in your calculation. All right. So at acquisition, the date of acquisition is the 31st of December 2018. Now, at that date, the net asset value or the equity of Vitamin Limited, which is the subsidiary, comprised of the following equity balances. So we first have share capital. Now, if they state share capital, they actually refer to ordinary share capital. All right. So ordinary share capital on the date of acquisition was 650,000. So you will enter that as such in your analysis of owner's equity. Okay, 650, of which 390,000 goes to the parent and 260,000 goes to non-controlling interests. All right. You will see that I've put in a formula here which automatically calculates the portion attributable to the parent based on the percentage that we have calculated here. So for example, if the percentage interest was 50%, then that amount will be different. Okay, it changes automatically. All right. So just take note of that as well. All right. But we have calculated that the parent has a 60% interest. So therefore, this will be your allocation. All right. Now, the amount for share capital was 650,000. Okay. And for the purposes of this model, we will assume that the share capital of the subsidiary does not change since acquisition. All right. So the balance at acquisition, which was 650, should also be the balance at year end as given in your trial balance. So if you go to your credit section, you will see that the share capital ordinary shares for the subsidiary is also 650,000 on the 31st of May 2021. Okay, so there has not been any change in share capital since acquisition. All right. And that will be the case for this module. Okay, the share capital has not changed, and you will also get confirmation in point 2, which we'll work through a bit later on. Okay, or after we are done with this one. Okay. Then we have preference share capital, and we already know that we are dealing with 9% cumulative preference shares. Please do not disregard the 9% because we will use that in order to calculate the preference dividends that must be paid by the subsidiary. Okay. The preference share capital on the date of acquisition was 300,000. Once again, we will assume that this has not changed since acquisition in this module. So if you go to your trial balance, you will see that the preference share capital issued by the subsidiary is also 300,000 Rand on the 31st of May 2021, which is the current financial year end. So since we have already entered this amount in our calculations, we will just cross this one out. Okay. Then we go to retained earnings. So the retained earnings balance of the subsidiary on the date of acquisition was 1.68 million. 1.68 million. Okay. And then we have revaluation surplus for the subsidiary that amounted to 2,820,500 Rand on the date of acquisition. So 2,820,500. All right. Then they state that Vitamin Limited classified the cumulative preference share capital as equity. Okay, also that will be the case in every question in FAC2602. Okay, we will treat the preference share capital as equity because remember that you can have redeemable preference shares, okay, that can be classified as either equity or debt, okay, depending on the redemption date. I suggest you refer back to Learning Unit 9 for a more detailed explanation on that. But for this model, we will treat preference share capital as equity. And we will assume that the preference shares are cumulative, meaning that if a preference dividend has not been declared in a specific financial year, we will need to move that specific dividend over to the next period. Okay, and we will need to pay that dividend in the next period when the preference dividend is declared. And you will see that in this question as well. There would be preference dividends in arrears at the beginning of the year, and it was only paid at the end of this year. Okay, but we'll get to that. So just note that we will treat preference shares as part of equity and not debt. All right, and we will assume that those preference shares are cumulative, and no preference dividends were in arrears at acquisition, meaning that all outstanding preference dividends before acquisition were paid on the date of acquisition, meaning that there was no preference dividend that needed to be paid on the date of acquisition. Okay, that's why they state that there was no preference dividends or were no preference dividends in arrears at acquisition. Okay, which is also normally the case in this module. Because if there were preference dividends in arrears, you will still need to pay those dividends to the parent and non-controlling interest, meaning that if you had preference dividends in arrears at the date of acquisition, you will need to add it to this amount right here. Okay, and that will again affect the amount for goodwill. All right. But in this question, that will not be the case. Okay, so we have determined the date of acquisition. We have entered all these amounts as at the date of acquisition, and we have taken note of the fact that we treat preference share capital as part of equity. Okay. Right. Let's move on to point 2, which says the following. It is group policy to show goodwill at cost less impairment, and goodwill has not been impaired since acquisition. Okay, that will also be the case in every question in FAC2602. Okay, we do not deal with impairment losses relating to goodwill in FAC2602. Okay, that will be dealt with in third-year accounting modules, and some of you don't even have third-year accounting modules. Okay, now the issued share capital, as we have addressed in point 1 as well, of both companies remained unchanged since incorporation. Once again, this will be the case in every question in FAC2602. Okay, we will assume that there has not been any change in share capital of the subsidiary since the date of acquisition. Okay, that will also relate to the parent. Assume that each ordinary share carries 1 vote, and voting rights alone determine control, or are used to determine control. Now, all that this information states is that you will only use the percentage of ordinary shares owned by the parent in order to determine whether the group is actually formed. And for the purposes of this module, we know that the group will be formed if the parent owns a majority, so more than 50% of the ordinary shares of the subsidiary. Okay, so in your analysis of owner's equity, this percentage right here, and this is the analysis of owner's equity of ordinary shares, this percentage right here must exceed 50%, okay, in this module. Okay, otherwise you didn't calculate it correctly. Okay, because we know that voting rights are normally only attached to ordinary shares. So in other words, the parent must own more than 50% of the ordinary shares in order for the group to be actually formed. So what it comes down to is that this percentage right here cannot be lower than 50%. Okay, your preference share capital percentage can be lower than 50% because we do not use the preference share capital in order to determine control. Okay, but for your ordinary shares, this percentage must be more than 50%. Okay, so please take note of that as well. And then we are still calculating the amount for goodwill because we will need to make certain adjustments right here, and we'll get to that. All right. So just keep in mind that we need to show goodwill at cost, and no impairment losses will be written off, as impairment losses are not dealt with in this module. Okay, so we are done with point 2, just additional information that we need to take note of. Then point 3 says the following. Now, at the date of acquisition, which is the 31st of December 2018, all assets and liabilities of Vitamin Limited were measured at fair value except for a hectare of land. All right. Now, this hectare of land had a carrying amount of 1.7 million rand and was valued at 1,925,000 rand on the acquisition date. Okay. The revaluation surplus in Vitamin Limited at the beginning of the current financial year amounted to 3,436,220 rand, and Ginger Limited did not have any revaluations in the current year or any other revaluations in the current year. Okay, so we will have to break point 3 down into 3 parts. Okay, the first part is where we have to adjust the given revaluation surplus on the date of acquisition, which was this amount right here. Okay, so this amount was given for revaluation surplus at the date of acquisition, but we still have to record, or we have to take into account that there was another revaluation on the same date of this amount right here, and the difference between these two amounts would be 225,000. So for part 1 of this point, we will need to adjust the revaluation surplus balance at the date of acquisition by 225,000 in order to calculate the real balance of revaluation surplus at the date of acquisition. Okay, and this adjustment is important because once again it will affect the amount of goodwill that was paid by the parent. Okay, so for part 1, we will adjust the given revaluation surplus balance of 2,820,500 rand, and we will adjust that by 225,000. Okay, how did we arrive at the 225,000? We subtracted the 1.7 million from 1,925,000. The difference between these amounts would be the revaluation surplus gained on the date of acquisition for this specific hectare of land, and we still need to record this adjustment in the balance right here. Okay, in order to calculate the correct balance for revaluation surplus on the date of acquisition, and your actual balance for revaluation surplus for the subsidiary at the date of acquisition should thus be 3,045,500. So this is the correct balance for revaluation surplus on the date of acquisition. Okay, so that is the only adjustment that you need to make with this one. Okay, you need to adjust the given revaluation surplus amount at the date of acquisition in order to calculate the real balance of RVS at the date of acquisition. Okay, but keep in mind that the revaluation surplus of 225,000 is part of the closing balance right here. Okay, so that's why I say the only adjustment that you need to make is that you need to calculate the real balance or the correct balance for revaluation surplus at the date of acquisition. But you also need to keep in mind that since it occurred on the date of acquisition, it should already form part of the retained earning or the revaluation surplus balance at year end. Okay, so that is very important. Okay, so we only adjusted the revaluation surplus amount at the date of acquisition, and the correct balance is therefore 3,045,500 rand. Okay, now let's move over to part 2 of this question, or this point rather. It says that the revaluation surplus in the subsidiary at the beginning of the current year, so this is the balance of RVS on the 1st of June 2020 for Vitamin Limited, being 3,436,220 rand. Okay, so there was clearly another revaluation that occurred between the date of acquisition, which was the 31st of December 2018, and the 1st of June 2020, which is the beginning of this year. There was another revaluation that occurred between those two dates. All right. So in your analysis of owner's equity, in your since acquisition to the beginning of the current year section, and we know that the beginning of this year was the 1st of June 2020, the revaluation surplus for that period is calculated by taking the opening balance, so the balance of revaluation surplus on the 1st of June 2020, which is 3,436,220, and then we will subtract the correct balance of RVS at the date of acquisition, which is 3,045,500. So the difference between these two amounts right here will give you the amount for revaluation surplus that occurred between acquisition and the beginning of this year. Okay, and if you calculate this correctly, let me just copy this. So the value of revaluation surplus that occurred between acquisition and the beginning of this year for the subsidiary is 390,720, of which 234,432 goes to the parent and 156,288 goes to the non-controlling interest. Now these two amounts are very important, okay, because remember that we are drafting the consolidated statement of changes in equity. So because it occurred before the beginning of this year, okay, so it occurred after acquisition, so it forms part of the group, so it cannot be eliminated. It occurred between the date of acquisition and the beginning of this year. These two amounts will be included in the opening balances for retained earnings and non-controlling interests, as is reflected in your consolidated statement of changes in equity. Okay, what do I mean by this? If you go to your consolidated statement of changes in equity, you will need to calculate the opening balance for share capital, retained earnings, revaluation surplus, and non-controlling interests. And we know that the beginning of this year is the 1st of June 2020. So because that RVS occurred after acquisition, okay, it forms part of the group, so it cannot be eliminated. However, we need to split the amount between the parent and non-controlling interests. Okay, and we know from our calculation that 234,432 must go to the parent. Okay, and it will be included in the opening balance because it occurred before the beginning of this year. So therefore, this amount right here would be included in the opening balance for revaluation surplus that is attributable to the parent. Okay, because that is the parent's share in that amount, and 156,288 will go to non-controlling interest. So it will be part of this amount right here. Okay, why? Because it occurred after acquisition, so it forms part of the group, but it was before the beginning of this year. So therefore, these two amounts would form part of the opening balances for these two columns respectively. Okay, so please take note of that. If you want to be more detailed, you could just say that this was revaluation surplus. Okay, that must be included in the opening balance for this column right here. Okay. Once again, this is why it's important for you to make sure that you have calculated the percentage correctly. Okay, because otherwise these two amounts would not be correct, even though this one may be correct. Right. Then the final part of this point is where we are asked to calculate the current year's revaluation surplus. And furthermore, they state that the parent did not have any revaluation in the current year. Okay, so the current year's revaluation surplus for the subsidiary will be calculated by taking the closing balance, so the balance as at the 31st of May 2021, which is 3,710,300. So 3,710,300, and we will subtract the opening balance for RVS for the subsidiary, which was 3,436,220. Okay, the difference between these two will give you the current year's revaluation surplus. Okay, and that will be equal to 274,080 Rand. Okay, so because this has occurred in the current financial year, you have to indicate this amount of 274,080 as part of the consolidated statement of changes, the consolidated statement of profit or loss and other comprehensive income. Okay, this will be shown in the other comprehensive income section as revaluation surplus for the group because it occurred in the current financial year. So in your consolidated statement of profit or loss and other comprehensive income, in your other comprehensive income section, and this is according to calculation 1, because calculation 1 is the analysis of owner's equity of ordinary shares. And in that calculation, we have calculated that the amount of revaluation surplus for the current year for the subsidiary is 274,080. Okay, and as I've said, as we are working through each point, we will make the adjustment at every possible place that it will have an effect. Okay, so we already determined that these two will be part of opening balances for revaluation surplus and non-controlling interests in the consolidated statement of changes in equity. Remember that this amount right here will be eliminated, okay, because it occurred at acquisition. This will be part of the elimination of owner's equity at acquisition. Okay, so we are not concerned with this amount. We have apportioned these two amounts correctly, as I've indicated here. We have said that these two amounts will form part of opening balance because it occurred between acquisition and the beginning of the current year. So it will form part of opening balance. And then the current year's revaluation surplus of 274,080 once again must be apportioned between the parent and non-controlling interests. Okay, the amount that goes to the parent is 164,448. So in your consolidated statement of changes in equity, you will show that other comprehensive income attributable to the parent is 164,448, and the amount attributable to non-controlling interests would be 109,632. Yes, 109,632. Okay, and the sum of these two will give you the total comprehensive income for the group. So this amount right here should correspond to the amount that you have shown here in the consolidated statement of profit or loss and other comprehensive income. But in the consolidated statement of changes in equity, you need to allocate the portion attributable to the parent and the portion attributable to non-controlling interests. Okay. All right, and because it occurred in the current year, it will be part of total comprehensive income for the year. Okay. However, this one would be part of opening balance because it occurred once again between the date of acquisition and the beginning of this year. Okay, so we will use these amounts as part of our calculation for the opening balances. Okay, just before we move on, we can already enter our opening balance for share capital, but that will only be for the parent, because we have once again stated that the share capital has not changed since acquisition. So the opening balance for share capital for the consolidated statement of changes in equity would be 500,000. Remember that we have eliminated the share capital of the subsidiary as part of the elimination of owner's equity at acquisition. So for the group, only the share capital amount will only be that for the parent. Okay, and if we go to retained earnings, we have an opening balance of 6,784,900. 6,784,900. That is the opening balance for the parent. Okay, and for revaluation surplus, because there was no revaluation for the parent in the current year, we will take the balance of 4,889,650 as the opening balance for RVS for the parent. Okay, so this was both the opening and closing balance because there was no revaluation in Ginger Limited's records for the current year, as stated in point 3. Okay, so this will be the opening balance for RVS in the consolidated statement of changes in equity. 4,889,650. This is the opening balance for the parent. Right. Okay, guys, I know I'm jumping a bit around, but as I've said, we need to make the adjustments as far as we can. Okay, if we can save time, that would be great. Okay, so since we have already entered this amount, we could just cross it out. Okay, and we have also entered this amount right here. Do not cross this one out yet. Oh, actually, we can do that. Okay, we will show this amount because it pertains to the subsidiary. This will be shown in the analysis of owner's equity of ordinary shares in your since acquisition to the beginning of the current year section. So if you go back to your analysis of owner's equity, this will be balance on the 1st of June 2020. Because remember, in this section, we need to calculate the change in retained earnings. So we will take the balance on the 1st of June 2020, which is 5,687,370. 5,687,370. And then we will subtract the balance at acquisition, which was given as 1,680,000. Okay, and there will also be further adjustments that we need to make. And the only reason that I'm doing this is because we are drafting the entire set of consolidated financial statements. All right, and in the examination, in this question specifically, you would need to draft the retained earnings column in the consolidated statement of changes in equity. So that's why I say this calculation is quite important. You cannot just leave it out, because we need to allocate the parent's portion to opening balance for retained earnings here as well. Okay, same as with revaluation surplus. Okay, but let's move on. We have made all possible adjustments that we could have made thus far. So let's move on to point 3, point 4 rather, which says the following. Point 4 says the following. On the 1st of December 2019, Ginger Limited sold 3 farm tractors to Vitamin Limited for a cash consideration of 420,000 Rand each. Okay, the tractors had a carrying amount of 396,000 Rand each on this date of sale. Okay, the 1st of December 2019. The group depreciates the tractors at 25% per annum on the straight line method. Okay, the first thing that you need to determine is whether this is an intergroup sale. This is indeed an intergroup sale because the parent has sold depreciable assets to the subsidiary. And we all know that the group cannot enter into transactions with itself, and therefore we have to eliminate any intergroup transactions. In this case, we will be required to eliminate the unrealized profit or loss on the intergroup sale, as well as the unrealized depreciation. Okay, now very important that you first distinguish or determine the date of sale, which is the 1st of December 2019. The 1st of December 2019 is clearly in the previous financial year, and therefore we will make use of the retained earnings account as part of our pro forma consolidation journal entry. Okay, so our first step is to determine the unrealized profit or loss. Okay, so this will be calculated. Let me just make a heading here. So point 4, which deals with the intergroup sale of tractors. Okay, so our first step is to calculate the unrealized profit that was made by Ginger Limited. All right, so unrealized profit is equal to 3 times the difference. Okay, why do we use 3? Because remember that 3 tractors were sold intergroup, and they give you the cash consideration for each as well as the carrying amount for each one. So we have to multiply the answer by 3 because we are dealing with 3 tractors. Okay, the cash consideration received was 420,000. So the proceeds on sale was 420, while the carrying amount for each tractor was 396. So we clearly made a profit because the tractors were sold for more than their carrying values. Okay, and if you calculate this correctly, you should arrive at an amount of 72,000. Okay, we get an unrealized profit of 24,000 Rand per tractor, and if you multiply that by 3, you should arrive at an amount of 72,000. So 72,000 is the unrealized profit that we need to eliminate for consolidation purposes. So our journal entry, which you will not be required to show, okay, but it will just help you to determine which accounts are affected and where we have to add the amount or subtract the amount and so forth. All right. So please do not disregard your journal entries. These will help you in making the correct adjustments. Okay. So because this transaction occurred in a previous period, all right, we need to debit the retained earnings account, all right, because a profit was made. So we need to decrease the profit, all right, made by the company who sold the tractors intergroup. Okay. And since it occurred in a previous period, we will debit retained earnings for Ginger Limited because Ginger Limited made the profit of 72,000, and we will credit property, plant and equipment for Vitamin Limited because the profit that was made would be included in the carrying value of Vitamin Limited's property, plant and equipment. So in other words, the unrealized profit is included in property, plant and equipment for the subsidiary. So it's part of this amount right here. And since it is an unrealized profit, we need to eliminate that for consolidation purposes. So this is the journal entry that you will make in order to eliminate the unrealized profit. Okay, how does that affect our calculations? Firstly, because we are dealing with the retained earnings account for the parent, this will affect the opening balance for retained earnings for the group. Okay, so in other words, you need to show in your consolidated statement of changes in equity that you will subtract 72,000 from retained earnings, okay, because the profit was made in a previous period and it is an unrealized profit. Okay, remember that all these adjustments will be used in order to calculate the opening balance for retained earnings correctly. Okay, this was the opening balance given in the trial balance, and the first adjustment that we need to make will be that we need to eliminate the unrealized profit of 72,000 because it was made by the parent. Okay, if the subsidiary made the profit, the adjustment will be shown in your analysis of owner's equity. Okay, but that is not the case, which is also important for you to, or why it is important for you to determine the parent and the subsidiary correctly. Okay, in this case, Ginger Limited sold the tractors intergroup, so therefore Ginger Limited made the unrealized profit. So therefore we have to debit the retained earnings account for Ginger Limited and not Vitamin Limited. Okay, can you also see why they always state with pro forma consolidation journal entries that you need to indicate clearly to which company each account refers? Okay, it now comes in very handy. Okay, if you can do that correctly. All right. So the adjustment will be shown here in your consolidated statement of changes in equity, because we know that this retained earnings column represents the portion attributable to the parent. Okay. And since the parent's retained earnings is affected with this adjustment, we need to show the adjustment right here. Okay, we will subtract 72,000 because retained earnings is debited. All right. Okay, guys, let me just take a quick break. I'll see you in about 5 minutes, hopefully. Okay, I'll be right back. Hi, guys. Sorry I took a while there. Definitely not 5 minutes that I've bargained on. Okay, so we are still working through point 4 and additional information. We are dealing with the intergroup sale of depreciable assets from the parent to the subsidiary. We have already determined the amount of the unrealized profit, which is 72,000, and we have made the appropriate journal entry. So the retained earnings account of the parent, okay, Ginger Limited, must be debited because the transaction occurred in a previous period, right, on the 1st of December 2019. So therefore, we have to decrease retained earnings of Ginger Limited. So in your consolidated statement of changes in equity, in your retained earnings column, you need to show the adjustment of 72,000, which is the elimination of the unrealized profit, and that will affect the opening balance for retained earnings attributable to owners of the parent. Okay, so just keep that in mind. And then we need to credit property, plant, and equipment for Vitamin Limited, as we have stated here. So in your consolidated statement of financial position, in your property, plant, and equipment line, you will start with the balances given in the trial balance, okay, for each company respectively. So we will start with land and buildings. Okay, so land and buildings, 11,069,000 plus land and buildings for the subsidiary, which is 10,256,930. Okay, 10,256,930. Then we add property, plant, and equipment, 3,140,800. 3,140,800. And then we add the property, plant, and equipment for the subsidiary, 2,339,840. Okay, and once we have entered these amounts, we could just cross them out. Okay, and keep in mind that even though land and buildings are separated from property, plant, and equipment, in your consolidated statement of financial position, you need to include land and buildings as part of property, plant, and equipment. Okay, so that is very important. Okay, and then we have to credit property, plant, and equipment for the subsidiary, which is the amount, or by the amount of the unrealized profit, which is 72,000, and we have calculated that correctly in our additional calculations. So in an exam situation, you will refer to this one as calculation 3, because your first two calculations would be the analysis of owner's equity, and this one would be part of your additional calculations. All right, and because property, plant, and equipment was credited, it is subtracted in your property, plant, and equipment line. Okay, so we're done with the first part, okay, where we have eliminated the unrealized profit made by the parent, okay, on this intergroup sale of the tractors. And the second part of this point will be where we are required to eliminate the unrealized depreciation. Okay, so the total unrealized depreciation that we need to eliminate, okay, based on 25% per annum on the straight line method, will be between the period of 1 December 2019 and the 31st of May 2021, which is the end of this financial year. Okay, that is the total unrealized depreciation that we need to eliminate. So unrealized depreciation that needs to be eliminated in total would be taking the unrealized profit of 72,000. We will multiply that by the depreciation rate, which is 25%. All right, and then if you look at the date of sale, which is the 1st of December 2019, from the 1st of December 2019 up until the end of this financial year, which is the 31st of May 2021, would give you a total of 18 months. All right, so 18 over 12. And this will be the total unrealized depreciation that we need to eliminate. And you should arrive at an amount of 27,000, I believe. Let me just confirm. Yes, it is indeed 27,000. So this is the total unrealized depreciation. But remember that of this total of 27,000, a certain portion pertains to the previous financial year and another portion pertains to the current year. Okay, and we need to eliminate the previous year's unrealized depreciation against retained earnings of the company that made the profit on the intergroup sale of these depreciable assets. Okay, so the portion of the 27,000 Rand, which is attributable to the previous period, okay, so this will be from the 1st of December 2019 to the 31st of May 2020, which was the end of the previous financial year, would be taking the amount of 27,000 and we will multiply that by 6 over 18. We will use 6 because that is the number of months between the 1st of December 2019 and the 31st of May 2020. And we will use 18 because we have calculated the total unrealized depreciation for 18 months. And since we are using the straight line method, okay, we do not need to first calculate the previous year's unrealized depreciation, then subtract it from the unrealized profit, and then calculate this year's unrealized depreciation. Okay, I'll show the example right now. Okay, so this is the method that you will use if it is straight line method. Okay, you calculate the total unrealized depreciation that needs to be eliminated. Okay, from the date of sale up until the end of this financial year, and then you need to split it between the previous period and the current period. All right, so the amount for the previous period should amount to, I think it was 9,000. Yes, it is 9,000 indeed. So 9,000 pertains to the previous period. So your current year amount would just be the difference between the total of 27,000 and the 9,000. Another way that you can calculate this is by taking the total of 27,000 multiplied by 12 over 18, because we want the amount for the current year that we need to eliminate. So we are seeking the amount for 12 months and we have 18 months based on this 27,000. Another way, and the third and final way actually, is to take the amount calculated for the previous period, which is 9,000, and you will multiply that by 12 over 6, or just by 2. Okay, you'll multiply that by 2. So this should give you an amount of 18,000. So 18,000 of this 27,000 is for the current year, and 9,000 is in respect of the previous year. So your journal entry will be that since an unrealized profit was made, okay, by the parent, okay, the subsidiary, the company that purchased these tractors, provides for too much depreciation in its financial records, okay, due to the unrealized profit that was made. So therefore we have to decrease the total depreciation provided for by the subsidiary. So therefore we have to debit accumulated depreciation for Vitamin Limited, and the amount that you will use here would be 27,000 because that is the total of unrealized depreciation that needs to be eliminated for consolidation purposes. We will then credit firstly retained earnings, okay, for the parent, which is Ginger Limited, and we credit the retained earnings. We credit the retained earnings account for Ginger Limited because Ginger Limited made the unrealized profit. So adjustments in respect of unrealized depreciation would need to be made against the relevant accounts of the parent, okay, which is Ginger Limited. And we use 9,000 because it relates to the previous period. And the second account that we will create will be depreciation, okay, or the depreciation expense. And if you look at your trial balance, you will see that depreciation is not shown separately. So therefore, we will assume that depreciation is part of other expenses. So you could also show that you are crediting other expenses. Okay, but normally you credit depreciation, but you can also credit other expenses because depreciation is part of other expenses. And this will be for Ginger Limited as well. And the amount here is 18,000 because it relates to the current year or the current year's unrealized depreciation that you need to eliminate for consolidation purposes. Okay, so let's account for this journal entry. So in your consolidated statement of financial position, because we are debiting accumulated depreciation, we are actually decreasing accumulated depreciation, meaning that the carrying value of property, plant, and equipment will increase. Okay, because we decrease the total depreciation provided for by the subsidiary. So in your consolidated statement of financial position, you will add the 27,000 to the property, plant, and equipment line because we have decreased accumulated depreciation, thus increasing the carrying value of property, plant, and equipment. All right. Good. And the second part of this question, or this adjustment rather, will be that we have to credit retained earnings of the parent. So once again, because it affects the retained earnings account of the parent, it will affect the opening balance for retained earnings for the group. So in your consolidated statement of changes in equity, you will need to show that you are increasing retained earnings by 9,000, and this is in respect of unrealized depreciation for the previous period. So this adjustment will be part of the opening balance right here because you are crediting the retained earnings account of the parent, which is also why we don't show it in the analysis of owner's equity, because the subsidiary didn't make the profit on this particular intergroup sale. So therefore, adjustments in respect of unrealized depreciation would also not be shown in the analysis of owner's equity. Okay, only where the subsidiary made the profit will the analysis of owner's equity be affected. All right. So we have credited retained earnings by 9,000. Okay, we will take it into account when we calculate the opening balance. And then we need to credit other expenses by 18,000. So in your consolidated statement of profit or loss and other comprehensive income, administrative expenses would just be the official term for other expenses. So we start with the amounts given in the trial balance for each company. So we will have for the parent, it is 4,859,120 plus other expenses for the subsidiary 3,351,310. Okay, and because we have entered these amounts already, we can just cross them out. Okay, and because we credit other expenses, we will actually show the adjustment as a decrease. Okay, so because depreciation is credited, we will show it as a negative amount or a negative adjustment in the administrative expenses line. Okay, elimination of unrealized depreciation for the current year. Okay, so we are now done with point 4. We have eliminated the unrealized profit on the intergroup sale of these 3 farm tractors, and we have eliminated the unrealized depreciation based on the straight line method. As I've said, I would just like to indicate what the procedure would have been if we used the reducing balance method. So this is just for explanation purposes. So if the reducing balance method was used, the procedure would be as follows, and this is only for the calculation of unrealized depreciation. Okay, so if we used the reducing balance method, okay, we would need to start with the previous period. Okay, so meaning that you have to first calculate the unrealized depreciation for the previous period, okay, which has ended on the 31st of May 2020, and you would have still got an amount of 9,000. So you would have taken the unrealized profit of 72,000, multiply by 25%, and then multiply by 6/12, which would have given you 9,000. Okay, the difference comes in with the current year's unrealized depreciation. If the reducing balance method was used, in order to calculate the current year's unrealized depreciation, you would need to subtract the unrealized depreciation in respect of the previous year, which is 9,000, from the unrealized profit, and then multiply that amount by 25%, which would have given you this year's unrealized depreciation, which is 15,750. Okay, so 15,750 would have been the current year's unrealized depreciation if the reducing balance method was used. Okay, so this is just for explanation purposes. In this question, they used the straight line method, so you could immediately calculate the unrealized depreciation for the entire period from the date of sale up until the end of this year, and then just split this amount between the previous period and the current year. However, if the reducing balance method was used, you would first need to calculate the unrealized depreciation for the previous year, and then subtract this amount from the unrealized profit when calculating this year's unrealized depreciation. Okay, it's very important that you know how to apply both methods, because they can ask either one. And I believe in question 1 of the May-June 2022 examination, there was a pro forma consolidation journal entry where the reducing balance method was used. Okay, so please go have a look at the first lesson for the May-June 2022 examination for another example where unrealized depreciation was calculated and eliminated based on the reducing balance method. Okay, in this question, we are only concerned with the straight line method, so you just take into account this section right here. And as I've said, the method will only affect the calculation of unrealized depreciation. Okay, the unrealized profit or the unrealized loss would be calculated in the normal way. All right, and something that I'd just like to mention as well, if an unrealized loss was made, then this journal entry would just literally be swapped, meaning that you will increase property, plant and equipment, so you will debit PPE of Vitamin Limited by 72,000, and you will credit retained earnings of Ginger Limited if a loss was made. So therefore, these two accounts would just be swapped. Okay, but in 98% of the cases, there will be an unrealized profit that was made. And if an unrealized loss was made, then this journal entry would just be the opposite as well. Okay, we will debit retained earnings, we will debit depreciation, and we will credit accumulated depreciation. Because in the case of an unrealized loss, the subsidiary will provide for too little depreciation in its financial records. So therefore, we need to increase the total depreciation that is provided for by the subsidiary. Okay, by increasing accumulated depreciation. That will be where a loss was made. Okay, but as I've said, in most cases, there is an unrealized profit that was made. But you need to know how to account for both an unrealized profit as well as an unrealized loss. All right, so this was just for explanation purposes. Okay, now that we have done with that, we can move on to point 5. Let me just breathe for a second. Okay. Now, point 5 says the following. Ginger Limited has a designated area for harvesting Clemengold oranges. The Clemengold seeds are obtained from Vitamin Limited, and both companies regard the sale of these seeds as inventory. So clearly we are dealing with an intergroup sale of inventory, okay, meaning that there will be an unrealized profit that we need to eliminate for consolidation purposes. Now, inventory, so these seeds are sold intergroup at a consistent markup of 25% on cost. And in September 2020, which is clearly within the current financial year, okay, it falls in the current financial year, Ginger Limited has purchased seeds of 874,000 Rand from Vitamin Limited. Okay, so this amount of 874,000 is the amount of intergroup sales for the current year that we need to eliminate for consolidation purposes. Okay, so in order to eliminate this one, we would need to, okay, so let's move on to our next heading. So point 5, intergroup sale of inventory. So to eliminate intergroup sales for the current year. Okay, can you also see why it's important to state your current financial year? Because then you would be able to see that the 1st of September or the September 2020 month falls within the current year. So therefore, this is intergroup sales for the year. All right. So to eliminate intergroup sales, we will debit the sales account of the company who sold the inventory, and in this case, it was Vitamin Limited. So we will debit sales of Vitamin Limited by 874,000, and we will credit cost of sales for Ginger Limited. Okay, the company that purchased the inventory Intergroup. All right, so in your consolidated statement of profit or loss and other comprehensive income, you will start with revenue, and as usual, we take firstly the balances from our given information, which will be reflected in your trial balances. So we will start with 3174,830, and then we will add the amount for revenue for the subsidiary, which is 14,048,000, and because sales is debited, we will decrease the group's revenue by 874. Okay, that is the elimination of intergroup sales. And then we also make the adjustment for cost of sales. Okay, so we are done with revenue. All right, so if we move over to cost of sales, you will start with the parent's amount for the year, which is 17,846,640, I believe. 17,846,640 plus 9,847,930, and because cost of sales was credited during the elimination of intergroup sales, we will show the adjustment as a negative amount. All right, so 874 is subtracted from both revenue and cost of sales because both of those accounts are decreased for the elimination of intergroup sales. All right. And then just keep in mind that we will use the markup of 25% in order to calculate the unrealized profit in opening inventory as well as closing inventory. Okay, so we cannot just eliminate intergroup sales. We also need to eliminate unrealized profit included in opening and closing inventory. All right. Guys, please just excuse me for a minute. Sorry, I had to do something real quick. Okay, so as I've said, we will use the markup of 25% on cost when calculating the unrealized profit included in opening and closing inventory, which will be addressed in point 6. Okay, so the only adjustment that we can make for point 5 will be the elimination of intergroup sales, which we have done in our consolidated statement of profit or loss. And also something that I like to emphasize, remember, if you eliminate intergroup amounts that were paid/received, okay, between the two companies in the group, that particular adjustment will be shown in your consolidated statement of profit or loss and other comprehensive income, meaning that we know that the subsidiary made the profit on the intergroup sales inventory. Only the elimination of the unrealized profit made by the subsidiary will be shown in your analysis of owner's equity. So in other words, what I'm trying to say here is that we will not show the elimination of intergroup sales in our analysis of owner's equity. Okay, we will only show the elimination of the unrealized profit in the analysis of owner's equity where the subsidiary has made the profit. Okay, so please keep that in mind. So the elimination of intergroup amounts that were paid/received between the two companies in the group will be shown in your consolidated statement of profit or loss and other comprehensive income. Only unrealized profits or losses that were made or suffered by the subsidiary will be shown in the analysis of owner's equity. All right, let's move over to point 6 now. Now, in the prior year, so in the previous financial year, Ginger Limited purchased 1.4 tons of seeds at 750,000 Rand per ton from Vitamin Limited. Okay, on the 1st of June 2020, which is the beginning of the current financial year, 0.7 tons of the 1.4 tons remained in Ginger Limited's possession. Okay, so we will use the 0.7 in order to calculate the opening inventory value for Ginger Limited, and this will be the value that was purchased into group. All right. Now, on the 31st of May, 2021, so at year end, 35% of the inventory in Ginger Limited comprised of purchases from Vitamin Limited. All right, let's first deal with opening inventory. Okay, so in your additional calculations, you will make another heading, 0.6, the elimination, or let's rather call it the unrealized profit in opening and closing inventory. All right, so for your opening inventory, okay, in order to calculate the unrealized profit, okay, we will start with the 0.7 tons, okay, because 0.7 tons were purchased into group and remained on hand on the 1st of June 2020. Okay, so 0.7 tons will be used as part of our calculation. Okay, in order to calculate the value of opening inventory that was purchased into group, so we will take 0.7, okay, times the price per ton, which is 750,000. So the answer that you get right here will give you the value of opening inventory that was purchased into group, and this is the value from which the unrealized profit needs to be eliminated. All right, and then we will multiply it by 25 over 125. We will use 25 because that is the unrealized profit percentage, okay, of 25% on cost according to 0.5, and we will use 125 because this amount right here already includes the unrealized profit that was made. Okay, so therefore we use 125. So the amount for the unrealized profit in opening inventory should be 105,000. Okay, so 105,000. That is the amount for unrealized profit in opening inventory. Okay, how did we calculate that? We took the 0.7 tons on hand, multiplied it by the price per ton, which is 750,000, and then we multiplied it by 25 over 125 in order to calculate the unrealized profit of 105,000. So your journal entry, in order to eliminate the unrealized profit in opening inventory, will be to debit retained earnings of the company that made the intergroup profit, and that was Vitamin Limited. Okay, 105,000. Okay, and then we credit cost of sales for the same company. All right, so this journal entry is for the purpose of eliminating the unrealized profit in opening inventory. And because the adjustment relates to the subsidiary, this one will need to be shown in your analysis of owner's equity. So in your analysis of owner's equity, you will debit retained earnings at the beginning of the year by 105,000. So in your since acquisition to the beginning of the current year section, you will need to show the adjustment of the unrealized profit included in Ginger Limited's opening inventory, okay, which we have calculated to be 105,000, and because we debit retained earnings, it will be decreased or subtracted from the balance on the 1st of June 2020. All right, so we have debited retained earnings for the subsidiary, and then we will credit cost of sales. Now this, because of this being an unrealized profit adjustment, we will also need to show it in the analysis of owner's equity in the current year section because it pertains to cost of sales for the year. So in your current year section, you will make the adjustment of the unrealized profit included in Ginger Limited's opening inventory, and the amount that was calculated is 105,000. Okay, we will show this amount as positive. Why? Because we have decreased the cost of sales account for the subsidiary. Okay, and by decreasing the cost of sales account, you will increase the profit after tax, which is why we show this as a positive adjustment in the current year section. However, in this section right here, you need to show it as a negative adjustment because retained earnings of the subsidiary was debited. So in other words, decreased. Okay, so regarding the cost of sales part, okay, we first had to show it in the analysis of owner's equity, okay, under the current year section, but we also need to show it in our consolidated statement of profit or loss and other comprehensive income, where we have credited cost of sales, meaning that we decrease the cost of sales amount for the group by 105,000, okay, which is the amount of the unrealized profit included in opening inventory. All right, so we are done with the opening inventory. Let's move to closing inventory. So the unrealized profit in closing inventory will be calculated by taking the inventory value of Ginger Limited, okay, not Vitamin Limited, okay, because remember that the parent has purchased the inventory, okay, so we need to consider the inventory value for the parent, okay, being Ginger Limited. So in order to calculate the unrealized profit in closing inventory, we will take the inventory value for the parent, which is 9,450,760, so 9,450,760 Rand. Okay, we will then multiply it by 35% because of this value, okay, of this value, only 35% was purchased intra-group. Okay, so therefore we need to multiply this by 35% in order to calculate the amount for closing inventory that was purchased intra-group, because that will be the portion that includes the unrealized profit that we need to eliminate. And according to additional information point 6, 35% of the closing inventory of Ginger Limited comprised of intra-group purchases, so purchases from Vitamin Limited. Okay, be very careful when you read your information, because another way that they could have stated this is on the 31st of May 2021, 65% of the inventory in Ginger Limited comprised of purchases that were, let me just put this in another way. So an alternative way that they could have stated this piece of information would be that on the 31st of May 2021, 65% of the inventory in Ginger Limited was not purchased intra-group. Okay, so if 65% of the inventory of Ginger Limited was not purchased intra-group, then the remaining 35% were purchased intra-group. Okay, and we only need to consider the portion that was purchased intra-group when calculating the unrealized profit. So in other words, it would be incorrect to just multiply this amount by 25 over 125, because not all the inventory was purchased intra-group. Only 35% was purchased intra-group. So what I'm trying to say here is that you need to read your additional information very carefully. Okay, especially when it comes to unrealized profits that need to be eliminated. Okay, so we have multiplied this by 35% in order to get the value of closing inventory that contains the unrealized profit that we need to eliminate, and we will again multiply that by 25 over 125 because 25 was the profit made on cost, and 125 is used because this value already includes the unrealized profit that was made by the subsidiary. And if you calculate this correctly, you should arrive at an amount of 661,553 Rand. Okay, so this is the unrealized profit that was made on the intra-group sale, or that is included in closing inventory. Okay, that we need to eliminate for consolidation purposes. And according to your please note section, you need to round off all amounts to the nearest Rand, which is why we showed it as 661,553. Okay, you actually get 20 cents as well, but we ignore cents in this model. Okay, so now that we have calculated the unrealized profit in closing inventory, we can eliminate the unrealized profit in closing inventory by debiting cost of sales of the company that made the unrealized profit, which was Vitamin Limited, 661553, and we will credit inventory of Ginger Limited because of the fact that the unrealized profit is included in the closing inventory of Ginger Limited. Okay, 661553. Okay, so firstly in the analysis of owner's equity, because the subsidiary made the unrealized profit, so we need to show this adjustment in the analysis of owner's equity. So in the current year section, you will also state unrealized profit included in Ginger Limited's closing inventory. Okay, and the amount that we will use is 661553 or 661,553. And because we have debited cost of sales, we increase cost of sales for the subsidiary, and that will decrease the profit for the year, or the profit after tax. Okay, which is why we show this as a negative adjustment in the analysis of owner's equity, because we have increased cost of sales, therefore decreasing the profit after tax as given or calculated. And the second adjustment will need to be made in the consolidated statement of profit or loss and other comprehensive income. Because we have debited cost of sales, we increase cost of sales for the group, thereby adding 661553. Okay, and then the second part of this journal entry, which is crediting inventory, in your consolidated statement of financial position. Okay, if you go to inventories, the value for the parent, as given in the trial balances, is 9450760. Remember that we only multiply this amount by 35% in order to calculate the portion that includes the unrealized profit. Okay, but we still need to consider the whole amount in calculating the value of inventories for the group. Okay, so we take the amount of 9450760 as given in the trial balance. We add the value for the subsidiary, which is 8289,300. All right, 8289,300. And because we have credited inventory with this journal entry, we are showing the adjustment as negative. Okay, 661553. Okay, this is the elimination of unrealized profit included in closing inventory. So your total value for inventories for the group will be 17,078,507 Rand. Okay, that is the value for inventories for the group. Okay, as at the 31st of May 2021. All right, so for this point under additional information, we can subtract cross our cost of sales as well. Sorry, I forgot this, because we have already entered it into our consolidated statement of profit or loss and other comprehensive income. So we could just cross that one out as well. So for additional information, point 6, we were required to eliminate the unrealized profit in opening inventory as well as closing inventory. Okay, because they were intergroup sales in the previous year, of which some inventory were on hand at the beginning of the year. So that included unrealized profit. And at year end, the 31st of May 2021, there was also unrealized profit in the closing inventory for Ginger Limited that we also had to eliminate for consolidation purposes. We have shown the adjustments in the consolidated statement of profit or loss and other comprehensive income, as well as in the analysis of owner's equity of Vitamin Limited's ordinary share capital. Why is it shown here? Because the subsidiary made the unrealized profit. Okay, it is not shown here. Okay, because remember that this retained earnings pertains to the parent. Okay, and the parent's retained earnings were not affected by additional information point 6 adjustments. Okay, so now we can actually calculate the amount for revenue as well as cost of sales for the group. These will be the only adjustments that affect these two line items. So the amount for revenue for the group is 43,348,830 Rand. And for cost of sales, it will be 27,377,123. We just need to show this as a negative amount because it needs to be subtracted from revenue in order to calculate the gross profit correctly. So this will be your gross profit for the group. Okay, 15,971,707. All right, so we are done with additional information point 6. All right, let's move on to point 7. Let me just see if I've crossed out inventory. Yes, I did. Okay, let's move to additional information point 7, which says the following. Interest on the intergroup loan. So there was a loan, or there is an existing loan between the two companies in the group. Interest was calculated at 6% per annum, which is payable annually in arrears and has already been accounted for. Now, if you go to your trial balance for both companies, you will see that we do not have a separate line item for finance costs or interest expense, meaning that the amount of interest paid will be part of other expenses because it is not shown separately. Okay, interest received is also not shown separately, so therefore it will be part of other income. Okay, you may make that assumption if interest is not shown separately in your given trial balances. Okay, so interest for the full year has been accounted for. Okay, however, capital repayments of 25,000 Rand each, all right, were made on the 31st of July and are made rather on the 31st of July and the 31st of January each year. Okay, the interest does not qualify for capitalization and is expensed in the year in which it is incurred. Okay, now the only thing that you take note of here is that the interest is not added to the loan accounts, okay, or the value of the balance of the loan outstanding. Okay, so we do not allocate interest to the balance outstanding for that particular intergroup loan. So let's first determine the value of the intergroup loan by going back to our let's go back to our given information or given figures, which is reflected in the trial balances. So you will have in the debit section, you will have a loan that was granted to Ginger Limited. So a loan was granted to the parent amounting to 1,013,200 Rand. And if you go to your credit section, there should be a loan from Vitamin Limited, because in Ginger Limited's records, this will be shown as a liability, and in Vitamin Limited's records, this will be shown as an asset. Okay, keep that in mind. Amounting to the same amount. Okay, 1,013,200. Okay, what we need to take note of is the fact that this is the closing balance for the loan. So this is the balance on the 31st of May 2021. After the capital repayments of 25,000 Rand were made on the 31st of July and the 31st of January. Okay, so in order for us to calculate the interest correctly, we need to determine the opening balance of the loan, okay, by adding back the capital repayments that were made. Okay, so I'll show you now. And the reason why we are asked to calculate the interest is because it is intragroup interest that we need to eliminate for consolidation purposes. Okay, so interest on the intragroup loan, this is according to additional information point 7. All right, so point 7, intragroup interest. So we first need to determine the opening balance for the loan. So this is the balance on the 1st of June 2020, and we will calculate this amount by adding back the capital repayments that were made. All right, so we have loan balance on 1 June 2020. So we start with the closing balance of 1,013,200. We then add back the 25,000 Rand, which was paid on the 31st of January 2021. Okay, and we also need to add back the capital repayment that was made on the 31st of July 2020. Okay, which both of them will fall in the current financial year. So in effect, you will add back 50,000 Rand in total in order to calculate the opening balance of the loan pertaining to this financial year. And you should arrive at an amount of, let me just confirm this. So you should arrive at 1,063,200. Okay, so this is the opening balance for the loan, okay, on the 1st of June 2020. And because there are two capital repayments that were made in the current year, we will need to split the periods within this year in order to calculate the interest expense correctly. Okay, let me show you how this is done. So in order to calculate the interest expense for the year, we will divide this into 3 periods. Okay, I'll show you now. Interest expense for the year. Okay, and according to additional information point 7, the full amount of interest was accounted for. Okay, so meaning that the full amount was paid by Ginger Limited because the loan was granted to Ginger Limited, and the full amount of interest was received by Vitamin Limited. Okay, so interest for the year would be calculated as follows. So we will start with the beginning of this year, which is the 1st of June 2020, and we will end the first period on the 31st of July 2020, when the first capital repayment was made. Okay, because remember that you will calculate interest for a specific period based on the outstanding balance at the beginning of the period. Okay, and the first capital repayment was made on the 31st of July 2020. So our first period will end on the 31st of July 2020. So interest expense is calculated for this period by taking the opening balance of 1,063,200. That is the value of the loan on the 1st of June 2020. We will multiply by 6% because that is the given interest rate according to additional information point 7. And we need to multiply it by 2/12 because we want to calculate the interest for 2 months. Okay, June and July. All right. And you should arrive at an amount of 10,632 Rand. So that is the amount of interest for this period. Okay, and remember we need to cover the entire year. Okay, so from the 1st of June to the 31st of May. However, we need to divide that current year into 3 distinct periods because of the capital repayments that were made during the year. Okay, and because of those capital repayments, we will need to calculate the interest accordingly. Okay, so this is our first period. Okay, the 1st of June 2020 to the 31st of July 2020. All right, let me just indicate that we are calculating interest in total from the 1st of June 2020 to the 31st of May 2021 by dividing the year into 3 periods. Okay, our second period will be from the 1st of August 2020 and will end on the 31st of January 2021, which is when the second capital repayment was made. All right. Now the outstanding balance of the loan on the 1st of August 2020 is calculated by taking the opening balance of 1,063,200 and then subtracting the capital repayment of 25,000. All right. That will give you the opening balance or the balance of the loan outstanding as at the 1st of August 2020, and then we will multiply it by 6%, and we will calculate interest for 6 months. Okay, because that is the number of months between the 1st of August 2020 and the 31st of January 2021. Okay, August, September, October, November, December, and January. Okay, giving you a total of 6 months. So the total interest for this period will be 31,146 Rand. Okay, that is the amount of interest for this period. And then the third and final period for which interest must be calculated is from the 1st of February 2021 rather, up until the end of this year, which is the 31st of May 2021. So as you can see, we have started with 1st of June and we end on the 31st of May 2021. However, we make use of 3 different periods because of the 2 capital repayments that were made during the year. And the interest is calculated based on the value of the loan outstanding. And interest is not capitalized, so therefore this amount will not be added to the 106,300. Okay, so please keep that in mind as well. Okay, so interest for the final period would be calculated by taking the opening balance of 106,300 less the first capital repayment less another capital repayment, or you could just have taken the closing balance, which is 101,300, because that is the closing balance of the loan on the 31st of May 2021. Okay, the amount that you should have calculated here is 103,800. Okay, 103,800. Okay, that is the value of the loan on the 1st of August 2020. And then on the 1st of February 2021, after the second capital repayment has been made, the loan amounts to 101,300. Okay, which is also the closing balance as at the 31st of May 2021. Okay, once again, we multiply by 6% because that is the interest rate given. And we will then multiply by 4/12 because we want interest for 4 months. And if you add these up, 2 plus 6 gives you 8, plus 4 will give you 12 months. Okay, because we are calculating interest for the full year. All right, so interest for the last period amounts to 20,264 Rand. So therefore, total interest is 20,264 plus 31,146 plus 10,632, and this will give you the interest amount for the year. And you should arrive at an amount of 62,042 Rand. Okay, so this is the total value of intergroup interest for the current year that needs to be eliminated for consolidation purposes. All right. So therefore, our journal entry will be that we need to debit other income for Vitamin Limited because Vitamin Limited granted the loan to Ginger Limited. Okay. How do we know this? Because in Vitamin Limited's records, the loan is shown as a debit balance and it is shown as a loan to Ginger Limited. So Vitamin Limited would have received interest for that loan, while Ginger Limited would have paid the interest on that loan. Okay, and because interest is not shown separately, we assume that it is included in other income and other expenses respectively. So we will debit other income for Vitamin Limited, 62,042, and we will credit other expenses for Ginger Limited by the same amount. Okay, this is the amount for intergroup interest that needs to be eliminated for consolidation purposes. Okay, and since we are not dealing with an unrealized profit or loss, there is no adjustment in the analysis of owner's equity. Okay, only in the consolidated statement of profit or loss and other comprehensive income. So you will start with other income as given in the trial balances, which is for the parent, it is 11,533,000. 11,533,000. We will add the value of other income for the subsidiary, which is 11,065,900. And because we have debited other income for Vitamin Limited, we will show the adjustment as a negative adjustment. Okay, 62,042, which is the elimination of intergroup interest received. All right, and Then we will credit other expenses. So administrative expenses, we have already started with the adjustments. So we will just subtract 62042 from this line item as well. Okay, because other expenses is credited, we decrease the value of administrative expenses for the group. Okay, now just also something that I'd like to mention, and this doesn't really pertain to the intergroup interest. It rather pertains to the intergroup sale of those farm tractors. Okay. Once again, this is important this is why it is important that you determine your current financial year first and whether the transaction occurred in a previous period. Okay, because if that particular transaction occurred in the current financial year, okay, so let's say it occurred on the 1st of December 2020, all right, then you would have debited other income for Ginger Limited, okay, because then the profit would be included in its other income for the current year. But because this transaction occurred in a previous period, we use the retained earnings account and not the specific income item. So what I'd like to say here is that if the intergroup profit or the unrealized profit made on those tractors was made in the current financial year, then you would have subtracted it from other income in your consolidated statement of profit or loss and other comprehensive income. But according to additional information point 4, that transaction occurred in a previous period, okay, the 1st of December 2019. So therefore, we made use of retained earnings and not other income. Okay, so please go back to the adjustment for additional information point 4, just to again look at the procedure that we have followed in order to account for that specific adjustment. Okay, so for additional information point 7, we were first required to determine the opening balance of the loan. Okay, and we did that by taking the closing balance and then we added back the two capital repayments of 25,000 Rand each, and that gave us the opening balance for the loan. We then divided the whole year into 3 periods, okay, because we calculate interest based on the outstanding balance, and we know that 2 capital repayments were made, so we need to take that into account when calculating the interest for the year. Okay, using the rate of 6% per annum. Interest is not capitalized, so it is not added to the value of the loan itself. All right, and it has been fully accounted for by both Ginger Limited and Vitamin Limited. And we have shown the adjustment in our consolidated statement of profit or loss and other comprehensive income. All right, let's move on to point 7. Now, point 8 rather. Point 8 indicates that the profit after tax, so the profit for the year for Vitamin Limited, so for the subsidiary, amounts to 9,249,640 for the current financial year. And this is before any adjustments were made, right? So in your analysis of owner's equity, because this will affect the bottom section of the total comprehensive income statement, so this or that amount will have an effect on this one as well. All right, so therefore we have to show that amount in the analysis of owner's equity. Okay, under the current year section, the profit after tax for the subsidiary as calculated or given 9,249,640. Okay, now if you want to confirm this amount, okay, you can do that by taking your revenue amount for the subsidiary, which is 14,048,000. We add other income of 11,065,900. We will then subtract cost of sales 9,847,930. We will also subtract other expenses 335,1310, and we will subtract income tax expense because we want the profit after tax. So 2,665,020, and you will also get an amount of 9,249,640. Okay, so you could have calculated this amount as well. Okay, they just gave you this amount in order to help you save time. Okay, remember that this amount, again, is before any adjustments were made regarding intergroup sales, regarding unrealized profits, and so on. Okay, this is as per their own financial records. Okay, 9249640, and then we made the adjustments regarding unrealized profits included in inventory. All right. So that's the only adjustment that you need to make for point 8. You need to indicate that in the analysis of owner's equity in the current year section. And then all preference dividends since acquisition were declared and paid on the 31st of May 2021. Okay, what is the significance of this? This implies that between the date of acquisition, which was the 31st of December 2018, and the beginning of the current financial year, sorry about that. So between the 31st of December 2018 and the 1st of June 2020, the preference dividends were in arrears. Okay, because those dividends were only declared in the current year and paid in this year. All right. Now, what is the meaning of that? It means that we have to account for the preference dividends that are in arrears between acquisition and the beginning of this year. All right, and we will do that in our analysis of owner's equity. So, in your analysis of owner's equity of ordinary shares, you need to remove the preference dividends that are in arrears from acquisition to the beginning of the current year. Okay, and we will transfer this amount to the analysis of preference share capital. Okay, let me show you how you do this. Okay, because we have already determined that those dividends are in arrears, okay, because they were only paid at the end of the current financial year. And as I've said at the beginning, if we are dealing with cumulative preference shares, if the preference dividend has not been declared in the specific financial period, it must accumulate to the next period and be paid in that period. All right. So because the preference dividends between the date of acquisition and the beginning of the current financial year were in arrears, we need to subtract that amount from retained earnings for the subsidiary and then transfer it to preference share capital. Okay, let's get to that. So you will refer to this as preference dividends in arrears. Okay, and we will calculate this amount by taking the value of preference share capital for the subsidiary, which was 300,000. Okay, you will recall that we have, let me just remove a 0 here. So we have stated that in calculation 2, okay, the value of preference share capital for the subsidiary, 300,000. Okay, we will then multiply it by the dividend rate, which is 9%. Remember, for preference dividends, we calculate the dividend amount based on the value of the preference share capital, not the number of preference shares issued. Okay, and then we need to determine the number of months between the date of acquisition, which was the 31st of December 2018, and the 1st of June 2020. And you should get a total of 17 months. Okay, how do we get 17 months? We got 5 months between the 31st of December 2018 and the 31st of May 2019, all right, which was the end of that financial year. That gives you a total of 5 months. And then from the 1st of June 2019 up until the 31st of May 2020 is 12 months, logically, because that is a full year. And we are only concerned with the period between the 31st of December 2018 and the 1st of June 2020. Okay, so that will give you a total of 17 months for which the preference dividends are in arrears. So we need to remove this from retained earnings and transfer it to preference share capital analysis. So the amount subtracted is 38,250. Okay, so we will take this amount and then show it in our analysis of owner's equity of preference share capital. So in your since acquisition to the beginning of the current year, there is nothing more we can do in the at acquisition section. We are done with that. So since acquisition to the beginning of the current year, which is the 1st of June 2020, there are preference dividends in arrears that amount to 38,250, of which 26,775 is attributable to the parent, and the remaining 11,475 is allocated to non-controlling interests. Okay, what is the significance of this adjustment? This, again, because it relates to the beginning of the current year, it will affect the opening balances for those amounts in the consolidated statement of changes in equity. Okay, so meaning that it will affect the total value of the retained earnings of the parent, okay, as well as the value of non-controlling interest at the beginning of the year. Right. So in your consolidated statement of changes in equity, you will need to show that 26,775, which relates to preference dividends in arrears, must be added to the opening balance for retained earnings for the group. Okay, and this retained earnings will be attributable to the parent. Okay, and because these are in arrears, we owe that amount to the parent. Okay, as at the beginning of the year. Okay, so 26,775 must be added to the retained earnings column, opening balance. Okay, and the remaining 14 or 11 rather, 11,475 must be allocated to non-controlling interests. Okay, preference dividends in arrears. Okay, once again, it will form part of the opening balance for non-controlling interest because it occurred after acquisition but before the start of this financial year. So therefore, this amount would need to be considered in calculating the opening balance for non-controlling interests. All right, so what we have done here is that we have removed the preference dividends in arrears from retained earnings, okay, and we have transferred it to preference share capital to show that this amount is still owed to the parent and non-controlling interests, okay, as at the beginning of the year. All right, so we have made that adjustment, and then we also need to take into account the current year's preference dividends. Okay, so once again, we will follow the same procedure as we have done with the first one. So under your current year section, in the analysis of owner's equity of ordinary shares, you will need to calculate the current year's preference dividends by multiplying again 300,000, which is the value of preference share capital for the subsidiary, by 9%. And we will calculate that for 12 months. So we only need to multiply by 9%, which will give you 27,000. So we adjusted here against the profit after tax. Okay. And then we transferred this amount again to the analysis of owner's equity of preference share capital. All right. So in your analysis of owner's equity of preference share capital, under your current year section, you will show profit attributable to preference shareholders amounting to 27,000. Okay, of which 18,900 goes to the parent and 8,100 goes to the subsidiary. Okay, and then you will need to show that you have paid all the preference dividends in arrears, and if you add these two amounts together, it should give you 65,250. Okay, so this is the total value of preference dividends declared and paid by the subsidiary for the current year. Okay, because we have paid the current year's preference dividends as well as the preference dividends that were in arrears at the beginning of the year. Okay, and because these preference dividends were in arrears, it will affect the opening balances for retained earnings and non-controlling interests in our consolidated statement of changes in equity. Okay, and we will use this amount right here for non-controlling interests, okay, profit attributable to preference shareholders, in order to calculate the total comprehensive income attributable to non-controlling interests, okay, which we'll get to when we complete the consolidated statement of profit or loss and other comprehensive income. So just to confirm that we have calculated this amount correctly, if you go to your trial balance for Vitamin Limited, you will see that the total value of preference dividends declared and paid amounts to 65,250. Okay, so we have calculated this amount correctly. All right. Now, we have to get to the second part of this adjustment. Okay, remember that the parent received a portion of those preference dividends. Okay, so therefore there is an intra-group preference dividend that needs to be eliminated for consolidation purposes. All right. So just to make sure that you understand the journal entry, let me show you the journal entry that you will make. So point 9. 0.9 preference dividends declared and paid. We have calculated the total to be 65,250, which was calculated by taking the preference dividends in arrears at the beginning of the year, which is 38,250, and we added the current year's preference dividends of 27,000. All right, so your intergroup dividend paid was calculated as 45,675. Okay, so the journal entry here would be the elimination of intergroup preference dividend, and recording the NCI's share in the preference dividends. Okay, and the journal entry that you will make will be as follows. We need to debit, because it was an intergroup dividend received, it will be part of Ginger Limited's other income. Okay, and because this is an intergroup transaction, we need to eliminate that for consolidation purposes. So you will decrease other income for Ginger Limited, okay, because their other income includes the preference dividend received, and that was 45,675. According to calculation 2, okay, 45,675. So in your consolidated statement of profit or loss and other comprehensive income, you will need to subtract 45,675 in your other income line, because that is the amount of intergroup preference dividends received, okay, which corresponds to this entry because we are debiting other income for Ginger Limited. We will also debit non-controlling interests. By the amount of preference dividends paid to non-controlling interests, and that is 19,575. Okay, so 19,575, and then we will credit preference dividends declared and paid by Vitamin Limited by 65,250. Right. So this journal entry eliminates the preference dividends declared and paid by removing the intergroup dividend and recording the non-controlling interest share in the preference dividends paid and declared for the current year. Alright, so we have shown the adjustment for the intergroup preference dividend. So the amount paid to non-controlling interest, which is 19,575, would be subtracted in the consolidated statement of changes in equity. So we will indicate that as such. So in your consolidated statement of changes in equity, in your non-controlling interest column, you will need to show that the dividends declared and paid that were preference dividends amounts to 475 rather. Or is it 575? Oh, sorry, it is 575, sorry. 19,575. Okay, this shows that we have debited non-controlling interests by the amount of 19,575 as part of our elimination of intergroup preference dividend and recording the NCI share in preference dividend for the current year, as well as those preference dividends that were in arrears. Okay, so we are done with the preference dividends. Okay, we have allocated the preference dividends in arrears at the beginning of the year to the opening balance for retained earnings and non-controlling interests in our consolidated statement of changes in equity. We have transferred the current year's preference dividends to preference share capital, and we have determined the total amount for preference dividends paid, after which we have eliminated intergroup preference dividends received, as well as recorded the NCI share in the current year's preference dividend. Okay, and remember, with preference dividend adjustments, it can be difficult. Okay, so please practice as much as you can. There are a lot of examples in Learning Unit 9 that addresses the treatment of preference dividends. Okay, so please make sure that if you're not comfortable or familiar with the treatment of preference dividends, that you go revisit Learning Unit 9, okay? Because the chances are that it will definitely be included in the upcoming examination. All right. Good. And now we have to deal with the preference or the ordinary dividends. Okay, so we are done with all the points under additional information, and now we need to move to our remaining items. Okay, so let's first address the ordinary dividends declared and paid. Okay, once again, please note that the parent has not paid or declared any preference dividends because preference shares in issue. Okay, that only pertains to the subsidiary. So when it comes to your ordinary dividends declared and paid, the total declared and paid by the parent is 281,800. Okay, and because this was paid by the parent, there is no portion that was intergroup. Okay, because remember that the subsidiary is not a shareholder of the parent. Okay, it's vice versa. Okay, the other way around. The parent is a shareholder of the subsidiary. So any dividends paid by the subsidiary, a portion thereof would be paid to the parent, okay, which is an intergroup transaction. But when it's the other way around, so when the parent has declared dividends, there is no intergroup portion, okay, because the subsidiary is not a shareholder of the parent. Okay, the parent is a shareholder of the subsidiary. Okay, it's very important that you understand this concept. So what it comes down to is the amount of 281,800 will be shown in full in the consolidated statement of changes in equity in your retained earnings column. Right? So in your consolidated statement of changes in equity, in your retained earnings column, you will show dividends declared and paid by the parent is 281,800. Okay, and the closing balance is at the 1st of May 2021. Okay. So we will show the full amount of dividends paid by the parent in the retained earnings column. And then we need to look at the amount paid by the subsidiary. Okay, 179,600, which we'll show in our analysis of owner's equity, because we want to determine the amount paid to the parent and the amount paid to non-controlling interests. Okay, the principle remains the same as with the preference dividends. Okay, so your second adjustment here will be the elimination of intergroup ordinary dividend, right? And recording the NCI share in ordinary dividends or ordinary dividend. So the journal entry that you need to make here will be that once again we have to debit other income for Ginger Limited, because the dividend received, more specifically the ordinary dividend received by Ginger Limited, will be included in its other income. Alright, so we will debit other income for Ginger Limited by 107,760, because that was the amount of preference dividends paid to the parent. Okay, or ordinary dividends paid to the parent is 107,760. So once again, in your analysis or in your considered statement of profit or loss and other comprehensive income, you need to subtract 107,760 from other income because it is debited by this journal entry. Okay, elimination of intergroup ordinary dividend. We will then debit non-controlling interests. Okay, by the amount of 71,840. Let me just confirm. It is indeed 71,840. Alright, 71,840. And then we will credit ordinary dividends paid and or declared and paid rather, because you first need to declare it, then you can actually pay the dividends. So we will credit ordinary dividends declared and paid by Vitamin Limited, which amounted to 179,600. As per our analysis of owner's equity, as per the given information in the trial balances. So this journal entry is the elimination of intergroup ordinary dividend and the recording of the NCI share in ordinary dividend for the year. Okay, so we can just cross this line out. because we have addressed that. And we have already made the adjustment of the 107,760 in our consolidated statement of profit or loss and other comprehensive income. So therefore, we only need to record the non-controlling interest share in the consolidated statement of changes in equity. So you will show it here as 71,840. And because non-controlling interest were debited or was debited, we show it as a negative amount in the consolidated statement of changes in equity in the NCI column. Okay, 71,840. And once again, the full amount of the full amount of ordinary dividends paid by the parent will be shown in the retained earnings column. Because remember that if you look at your consolidated statement of changes in equity, this section right here pertains to owners of the parent, and this section pertains to non-controlling interests. Alright. So therefore, when we talk about retained earnings, we talk about retained earnings that are attributable to the parent. Okay. Alright. Let me just also cross out the intergroup loan, because we will eliminate that for consolidation purposes as well. This will not be shown in your consolidated statement of financial position. So you will just eliminate these loans against one another, or these loan accounts against each other. So in other words, you will credit loan to Ginger Limited, and you will debit loan from Vitamin Limited, both by the amount of 1,013,200. Okay, we can cross out other income as well, because we have entered that in our consolidated statement of profit or loss and other comprehensive income. Alright, and the only adjustment that we need to make for the consolidated statement of profit or loss will be the income tax expense. Remember, we ignore the taxation effect on unrealized profits or losses, so we take the amount as is. So income tax expense for the group would be that of the parent, which is 3,979,490, and then we add the income tax expense of the subsidiary, which is 2,665,020. Alright, and because we have entered that, we can just cross it out. Okay, so we are almost done with the consolidated statement of profit or loss and other comprehensive income. Okay, we do need to complete the final section as well, but we will complete the final section after we have completed the analysis of owner's equity. Okay, because these amounts are determined using your analysis of owner's equity calculations. Alright, so the amount of income tax expense for the group would be 6644510. We just need to multiply this by -1, because income tax expense must be subtracted from the profit before tax in order to give us. Ooh, that's fine. Okay, it must be subtracted from the profit before tax in order to give us the profit for the year for the group. Okay, there are no other adjustments, no other expense items or income items that we need to adjust. We have taken into account all the information under additional information, so we could just proceed to calculating the remaining amounts. So the total amount for other income for the group would be 22,383,423. Your administrative expenses would be, okay, once again we need to multiply this by -1 because it must be shown as a negative amount. Okay, so your total administrative expenses amount to 8,130,388 Rand. No finance costs will be shown because remember that interest was intra-group, which we have eliminated, okay, for consideration purposes. Alright, so you get a profit, or the total comprehensive income for the year is 23,854,312 Rand. Okay, after taking into account the revaluation surplus for the subsidiary that took place in the current financial year. Okay, and we have addressed that calculation as well. Alright, So before you even do this section right here, you need to make sure that you have completed the analysis of owner's equity. All right, especially the current year section. All right, because remember that the consolidated statement of profit or loss and other comprehensive income takes into account the current year's figures. So for the purpose of calculating these amounts right here, more specifically the amount for non-controlling interests, we will need to focus on the current year section in our analysis of owner's equity, both for ordinary share capital as well as preference share capital. So in other words, we need to make sure this section is complete. And it is indeed, because we have made the necessary adjustments regarding the preference dividends and the unrealized profit in opening and closing inventory, and we have made those adjustments against the profit after tax as was given. And we have accounted for the current year's revaluation surplus and the ordinary dividends that were declared and paid by the subsidiary. Okay, let me just make sure this amount was calculated correctly. The sum of this one, and that one. Okay, please guys, make sure that your totals add up correctly. Okay. So in order to calculate the total comprehensive income that is attributable to non-controlling interests, okay, we will start with the amount from the profit after tax. So we focus on this line right here, the profit for the year after adjustments regarding unrealized profits and or depreciation, as well as provision for preference dividends. So after the preference dividends for the current year has been provided for. Okay, or after provision for preference dividends for the current year has been made. Okay, so the total amount attributable to non-controlling interests is 3,466,435. So this will be the first amount that we add right here, 3,466,435. Okay, 3,466,435. Then we will add the portion of the current year's revaluation surplus, which was the 274,080. That was attributable to non-controlling interest, because remember, we are working with total comprehensive income. So we need to consider profit after tax as well as other comprehensive income. So we have taken the NCI share in profit after tax after all adjustments have been made, and then we will add the non-controlling interest share in the current year's revaluation surplus, which was calculated as 109,632. And then we will calculate or add the current year's profit attributable to preference shareholders. And this amount appears in your analysis of owner's equity of preference share capital. Okay, the 8,100. Profit attributable to preference shareholders, 8,100. So this amount will be the total comprehensive income for the current year that is attributable to NCI. And you get an amount of 3,584,167 Rand. And your owners of the parent will just take out the remaining amount. So you will take total comprehensive income for the group, which is 23,854,312. And then we will subtract the portion attributable to NCI, which is 3,584,167. And that should give you the 270,145. Okay, and these two again need to add up to the total, which is 23,854,312. Okay, guys, I know there are a lot of adjustments involved in this question, but remember that we are doing the entire set of consolidated financial statements, so I'm trying to make it as comprehensive as possible, okay, for your learning purposes. Okay, so we are done with the consolidated statement of profit or loss and other comprehensive income. Okay, we are also done with our analysis of owner's equity, both for ordinary shares as well as preference shares. Alright. Let's move over to our consolidated sum of changes in equity. Okay, and I want us to focus on the opening balances first. Okay, so we have accounted for share capital. Okay, and here you need to focus. Alright, because this is quite a difficult calculation. Okay, so to calculate the retained earnings balance on the 1st of June 2020, we will start with the adjustments that we have made here. Okay, after taking into account all the information under additional information, we have started with 6,784,900. That was the opening balance for the parent. Okay, according to your trial balance. Okay, that appeared here. Okay, the 6,784,900. All right. Then we account for these adjustments. So we subtract the 72,000, which was the unrealized profit on those farm tractors. We add 9,000 for unrealized depreciation in respect of the previous period. Then we have to add the preference dividends in arrears at the beginning of the year, which was 26,775. And the final amount that we need to add would be the parent's share in retained earnings of the subsidiary from acquisition to the beginning of the current year, which was calculated as 2,318,472. Okay, that is the final amount that needs to be added. Remember that this section right here would be eliminated. Alright, so for the group, or for the opening balance of retained earnings for the group, we have to start with the opening balance for the parent, which was given, take into account all these adjustments that we have made, and then we need to add the portion of retained earnings from acquisition to the beginning of the current year for the subsidiary that is attributable to the parent. Okay, once again, you need to make all necessary adjustments here. Okay, in this section, we calculated the change in retained earnings from acquisition to the beginning of the current year, and we also accounted for the unrealized profit in opening inventory, as well as the preference dividends that were in arrears at the beginning of the year. Okay, the final amount, or the portion of the final amount attributable to the parent, must be added to the opening balance of retained earnings for the group. So your retained earnings balance for the group on the 1st of June 2020 is 9,067,147. Alright, and as I've said, this is indeed a very difficult calculation. You need to focus when you're doing this section. Okay, which is also why it's important for you to distinguish between the parent and the subsidiary correctly, especially when you are making adjustments regarding unrealized profits, as well as depreciation that you need to eliminate for consolidation purposes. And you also need to make sure that you have calculated the percentage interest correctly, because otherwise your calculations will be a mess. Alright, so we have started with the opening balance, accounted for all the adjustments, and then we added the parent's share in the subsidiary's retained earnings since acquisition, so after the group was formed, to the beginning of this year, because that would form part of the opening balance. Okay, and you get a total opening balance of 9,067,147. Alright, let's move over to revaluation surplus. So again, we start with the opening balance for the parent, which is 4,889,650. Okay, this was the opening balance of revaluation surplus for the parent. You will recall that there was no revaluation for Ginger Limited in the current year. Okay, let me just see how long this video is actually. Okay, it is quite long. Alright. But as you guys should have noticed, I'm doing a lot of explanation, a lot of detailed explanations actually. And I want to make the principles very clear to you so that you can understand what or why I'm making certain adjustments and why we are making these adjustments at certain places. Okay, and also note that we had 67 minutes to do the required section. So the consolidated statement of profit or loss and other comprehensive income, as well as only certain columns here, and only the only the non-current assets section. Okay, but since we are doing the entire set of consolidated financial statements, logically it takes us longer. Alright, which is why the video is so long. Okay, so back to my story. So For the opening balance for the of revaluation surplus, okay, attributable to owners of the parent, we start with the opening balance of the parent, which was 4,889,650. Okay, that was given in the trial balance. And then we add the portion of revaluation surplus attributable to the parent, which occurred between acquisition and the beginning of the current year. Okay. Once again, the RVS at acquisition will be eliminated. Right. So we only consider the opening balance for the parent as well as his portion or its portion in RVS of the subsidiary between acquisition and the beginning of this year. Alright, and you should arrive at an amount of 5,124,082. Alright, so that is the opening balance for revaluation surplus, okay, attributable to owners of the parent. Opening balance plus the parent's share in RVS between acquisition and beginning of this year. Okay, your non-controlling interest would be another difficult calculation. Okay, remember that the total column would just be the sum of these three. Okay, 14,691,229. Now, to calculate the non-controlling interest opening balance, okay, please pay attention to this calculation. Okay, once again, we start with the adjustments that we have accounted for right here. Okay, but remember that these will also be shown in your analysis of owner's equity. So you will use both of them in order to calculate the opening balance for non-controlling interests. So we start with the balance of NCI at acquisition, which was 2,150,200. Okay, remember that this amount is not eliminated. It is recorded at acquisition. Okay, 2,150,200. We then add the since acquisition to the beginning of the current year section amounts that are attributable to NCI. So we add the 1,545,648. Okay, so we started with this amount, right? That was recorded at acquisition. Then we added the portion of retained earnings attributable to NCI between acquisition and the beginning of the current year, because we are concerned with the opening balance, right? So we only focus on this section. We then add the 156,288, which is the portion of RVS attributable to NCI. Okay, that took place between acquisition and the beginning of this year. Okay, the 156,288. Then we go over to the analysis of preference share capital. We add the balance on the 31st of December 2018, which is 90,000. And then we have to add the preference dividends that were in arrears at the beginning of the year, which was 11,475, which we have also shown as part of our adjustments right here. So in other words, your total non-controlling interests on the 1st of June 2020 is 3,953,611 Rand. Okay, once again, I know it is a very difficult calculation. Okay, that's why I say you need to keep focused. Okay, or you need to remain focused when you calculate these amounts, right? Because they can cost you a lot of marks. And once again, can you see that if you did not draw up or draft the analysis of owner's equity, you will find it extremely difficult to calculate the opening balance for non-controlling interests, which is why I always say that it is important for you to do this particular calculation very carefully. Okay, do it as best you can, right? Okay, so in other words, the non-controlling interest balance on the 1st of June 2020, the beginning of this year, would just be the sum of these. Okay, because that is where the current year starts. We do not consider the current year because we are working with the opening balance. So this will give you an amount of 3,852,136, and then we add the same range for the preference share capital analysis. Okay, which will be the 90,000 plus the 11,475, which will give you 101,475 as reflected here, and this should confirm our opening balance for NCI 18,611. Okay, so total equity at the beginning of the year for the group is 18,644,840. Alright, then we move over to changes in equity for the year. Now, for this question, we do not have an equity at acquisition because the group was not formed in the current financial year. Alright, because if the group was formed in the current financial year, there would not be an opening balance for NCI. Okay, so then you will record the equity at acquisition right here. Alright, but for this question, that line will be irrelevant because the group was not formed in the current year and we have an opening balance for NCI. Okay, now we get to the total comprehensive income section. Okay, and this can also become quite complicated. Now, the amounts that you will use will be from your consolidated statement of comprehensive income or statement of profit or loss and other comprehensive income. Because in this section, you need to distinguish between what portion is profit for the year and what portion is other comprehensive income. Alright, now the way in which we do this is as follows. We will take the amounts that we have calculated in our consolidated statement of profit or loss and other comprehensive income, and we focus on this section right here. So the amount for the parent is 20,270,145 Rand. Okay, but remember that this amount includes the portion of revaluation surplus. Okay, of which was it? I think it was 164,488 or 164,448. Alright. So in other words, we need to remove the 164,448, which is included in this amount right here. And after we have removed that, the amount that remains will represent profit for the year that is attributable to owners of the parent. Okay. So in your consolidated statement of changes in equity, you will show that you will credit retained earnings by taking the total comprehensive income attributable to owners of the parent, which is 20,270,145. Okay, this amount again was calculated in the consolidated statement of profit or loss and other comprehensive income, and we need to remove the amount of other comprehensive income attributable to the parent, which is 164,448. Okay. So 20,105,697 goes to the parent's retained earnings account because that represents profit for the year. Okay. The same with the subsidiary. You will take the total amount of total comprehensive income, which is 3,584,167. 3,584,167. Okay, remember that this is total comprehensive income attributable to NCI. Okay, as we have calculated in the consolidated statement of profit or loss and other comprehensive income, and then we need to remove the portion of other comprehensive income, which was 109,632. So in other words, 3,474,535 Rand is attributable to NCI as profit for the year. Okay, and your total should be 23,580,232 for profit for the year for the group, and other comprehensive income we have already calculated that as 274,080. Okay, and for confirmation, you need to go back to your consolidated statement of profit or loss and other comprehensive income. This amount right here must correspond to this amount. Okay, other comprehensive income as reflected in the consolidated statement of profit or loss and other comprehensive income 274,080. Okay, so this one must correspond to that amount. And the profit for the year should also correspond to the profit for the year for the group. Okay, 23,580,232. So the amounts that you get here must be the same as reflected in your consolidated statement of profit or loss and other comprehensive income. Alright. So please pay attention to that calculation. And logically, the total comprehensive income for the year for the group, which is 23,854,312, should be the same as reflected right here in your consolidated statement of profit or loss and other comprehensive income. Okay, so please work very carefully through that explanation. Alright, And we have already accounted for the dividends declared and paid. We have addressed that. So we can just, we are done with the consolidated statement of changes in equity. Okay. And another way for confirming a specific amount would be for non-controlling interest. If you want to check if your non-controlling interests were calculated correctly, if you go to your analysis of owner's equity, the closing value of NCI, or the NCI column, okay, for ordinary shares, plus the closing balance for NCI of preference shares must give you the total NCI for the group at the end of the year. So what I mean by that is, if you take this amount right here, which is 7,356,363, all right, and we add the closing balance or the closing value for NCI in the analysis of preference share capital of 90,000, that should give you this amount right here, 7,446,363. Okay, just to check whether your calculations were correct. Alright, and then we can proceed to our final consolidated financial statement, which is the consolidated statement of financial position. So for property, plant, and equipment, we have already made the necessary adjustments. Sorry guys, let me just pause for a moment. I'll be back shortly. Sorry guys, I promise this is the last time that I will cause an interruption. Okay, so for our consolidated statement of financial position, we will start with our non-current asset section, which we have already addressed. Okay, we have already made all the necessary adjustments. Alright, so you should get a value of 26,761,570 as your value for the group's property, plant, and equipment. Okay, remember we have already taken into account land and buildings as well. Alright, and we have eliminated the unrealized profit as well as the unrealized depreciation. Now, for goodwill, you will need to go back to your analysis of owner's equity. For your ordinary shares, the parent paid a goodwill amount of 874,700, which was calculated by taking your investment in ordinary shares, which was 4.1 million, and we subtracted the parent's actual share in the subsidiary's equity at the date of acquisition, which was 3,225,300. The difference between these two amounts will give you 874,700. And remember that goodwill is fully attributable to the parent. It is not split between the parent and NCI. Alright. So for ordinary shares, we paid, or the parent paid goodwill amounting to 874,700. And then we will add the goodwill amount for preference shares, which was calculated to be 65. Again, it will be the difference between the 275, which is the investment in the preference shares at fair value, and we subtract the parent's actual share in preference share capital at the date of acquisition, which was 210,000. So the amount for goodwill for preference shares is 65,000. So total goodwill in your consideration of financial position would be 939,700. Okay, those are the only non-current assets that we have included in our non-current assets section. We have already calculated the value of inventory, 17,078,507. Trade and other receivables would be in your debits section. So we start with the parent's amount of 2,605,600, and then we add the amount for the subsidiary, which is 1,727,940. Okay, 1,727,940. Okay, there were no adjustments regarding trade and other receivables. Okay, so total trade and other receivables for the group is 4,333,540 Rand. Then we have cash and cash equivalents. We have favorable bank balance with Crazy Bank, which will be made up of 130,000 plus 58,125, which pertains to the subsidiary, and this gives you a total of 188,125. Alright, so that is the total for cash and cash equivalents for the group, 188,125. So your total assets amount to 49,301,442 Rand. Okay, for the group. Alright, so we are done with our debit section. So now we move over to our credit section. So we start with our equity and liabilities. Firstly, the equity attributable to owners of the parent, and these amounts will be taken from the consolidated statement of changes in equity. So for share capital, it will be before I get to that, let me just move it right here. So the amount for share capital attributable to owners of the parent will be the 500,000. Okay. Retained earnings was calculated to be 28,891,044. Right. And then other components of equity would just be revaluation surplus, which is 5288,530. That will give you a total of 34,679,574. The amount for non-controlling interests was calculated as 7,446,363, and therefore your total equity would be 42,125,937. Right, sorry about that. Then we move over to our non-current liabilities, and according to our trial balance, we have a long-term loan from Ether Bank amounting to 158,700. Right, so non-current liabilities would be 158,700. All right. Then we have trade and other payables, okay, which will be calculated by taking the balance for the period, which is 2,683,930, and then we have to add the subsidiaries amount, which is 4,075,900. Okay, and that should give you a total amount of 6,759,830 Rand. For trade and other payables, there were no other adjustments regarding that balance. And the final item that we have to add will be the bank overdraft that the subsidiary has with More Bank, which is 256,975. 256,975. All right. So we are done with credits and debits. We have worked through all points on additional information. So total equity and liabilities amount to 49,301,442, which should correspond to your total assets. Okay, 49,301,442. So I will consider that statement of financial position is in balance. Okay. This brings the session to an official close. As I've said throughout the session, this is a very comprehensive example, okay, of an exam type question, because firstly it was asked in a previous examination, and secondly, this session covered the entire set of consolidated financial statements. All right, and not only have we worked through the consolidated financial statements, or not only have we drafted all of those statements, but we have also paid attention to our calculations, especially in the analysis of owner's equity of preference share capital as well as ordinary share capital. All right. So this example should help you very much in preparing for the upcoming examination. If you were able to apply these principles correctly, you are mostly, I'm not saying mostly ready, but you are about 80% there towards getting a pass, okay, for this module. Okay, remember, you only need a 50% mark to pass, right? And especially for those of you who didn't submit assignment 2, I would advise you to focus as best you can on the upcoming examination, because the examination itself makes up 80% of your final mark. Or was it 75? I can't remember. It's either 75% or 80%, but I believe it is 80%. Alright. So focus on the questions in tutorial letter 102. Okay. If you don't have time, you do not have to do all 29 questions in tutorial letter 102. Just focus on the more difficult questions, right? Make sure you have worked through each example in the relevant learning units. Because remember, those examples form the basis for how you are going to approach an exam type question. Okay, and I'd just like to indicate something. Everything that I'm telling you guys, okay, all the principles that I'm applying in this type of question, I've used the same learning material as you guys. Right? I've also made use of each learning unit's examples as well as the exercise questions. And believe me, I have made mistakes. Okay, I'm not getting everything right from the start, rather. I do make mistakes, but it is through the course of learning from your mistakes that you actually get better with what you're doing. Right. So what I'm trying to say here is practice as much as you can. Okay, don't be discouraged if you make mistakes. Right. Learn from your mistakes. Okay, don't let your mistakes hold you back. And use this upcoming week in order to work through as much questions as possible. Okay, and if possible, try to attempt those questions under exam type conditions. Okay, try finishing that question within the specified time limits, right? And see if you can complete an examination paper within a given time, right? And as I've said in previous lessons as well, if you do not manage